management of MAS Financials that joins in as well. We do have Kamlesh Gandhi, who's the CMD, who joins us now. Thanks a lot, Mr. Gandhi, for joining in. Always a pleasure speaking with you. You've been fairly consistent in your guidance and performance as well, barring a few quarters. And this one seems to be that, at least on the AUM front, because you've been targeting AUM growth between 20 to 25%, and this time around it's come at 18%. In the past, you've said that you won't be chasing AUM growth at the cost of credit uncertainty. So is that one of the reasons? And what does this tell you about the next few quarters and your asset quality going forward?
Thank you, Mangalam. Nice connecting to you once again. You are absolutely right that we have been very responsible on what we commit and how we perform on the same. So if you say this quarter was no different, we could grow our AUM at around close to 18.25%. And if you see the profitability at a consolidated basis, before the adjustment of that one-time impact of labor provision was around 20.5%. So we are well on track. And if you see the quarter-on-quarter increase, as I had shared earlier, that the increase in AUM in Q3 over Q2 is at around 6%. So we are moving slowly but very solidly towards our trajectory of 20 to 25%. And we should see that coming within next 1 or 2 quarters.
All right, 1 or 2 quarters, 20 to 25% is what comes by. And what about asset quality? Because I look at your gross stage 3 assets, they're higher than your aspirations of about 2%. Because you've been looking at around 2%, the numbers around 2.5% thereabouts. Do you have a visibility of that coming down? And your 61 to 90 days per days overdue, that bucket also has increased. Last quarter it was your 30 to 60 days overdue, which moved by about 29 basis points. So is there a particular portfolio which is seeing pain? Can you help us understand this a little more?
See, on the overall asset quality and the time what we have passed through since last 18 months, I would very safely tell that this has been maintained at a very optimum level. We always aim to have a range bound asset quality between 2 to 2.5 to 2.75%. We could maintain that. And the movement within the buckets in the class whom we serve is as per the routine business. It's a routine business affair and nothing much to read in that. Because the borrowers whom we serve, we need to be flexible within the buckets less than 90. So just few movement here, a few basis point movement here or there within the bucket is nothing much to worry about. But having said that, we always are very cautious on the dictum of extending credit where it is due, tighten our collection mechanisms, and that's a continuous process that is going on. So we see our asset quality to be range bound and well within our yield metrics calculations.
Okay, Mr. Gandhi, this is Ritu. Quickly on your margins as well, obviously the rate cuts from RBI have helped. We've seen your margins improve by about 9 basis points as well. Going forward, do you expect this sort of trajectory to continue? What is the steady state you're targeting? And also on your return ratios, you've been talking about a 3% kind of a return on asset target. Currently, you're just a little under it, 2.8 or so. Do you think you could meaningfully improve the return ratios from here?
Definitely. There are 2-3 aspects to it. Number first, the transmission of rates. If you see the rates have reduced, the repo rate have reduced, but the transmission is yet to happen. So we are waiting for that cognizable transmission to happen in the interest rate. And number second, as we sweat our distribution channels. So once we have the optimum business coming from each of our distribution channels, I think our OPEX can come down a little, and that should take us to the trajectory of aspiring 3% on ROAs. I think that should come within few next quarters.
And sir, just a quick word on your AUM growth and where it'll come from. Your two-wheeler loans are growing pretty well, but on the CV front, we're seeing some pressure. In fact, there's a decline sequentially, and we've been hearing similar commentary from your other peers in the NBFC space as well. What's really happening in that portfolio, and when do you see a sort of a revival there? Some of the cues that perhaps will be coming in over the next few days from the budget as well.
As you very rightly marked that there has been some stress in the CV portfolio across the peers. At the same time, we don't have that sizable CV portfolio. But we are the ones, as I shared in the beginning of this interview, that we will always prioritize risk and profitability over just AUM growth. And our approach to CV was no different. So on a static basis, when we saw some stress in the early delinquencies, we have tightened our credit screens, and hence the growth was calibrated. And we see that this will come back within next 1 or 2 quarters. And one thing what I'd like to add is that there is a lot of overlapping in the MSME borrowers and the CV borrowers. So once the pain in the MSME segment eases, the CV segment should also see some easing on the asset quality. And that will be the right time to come back to the normal growth of around, say, 20-25%, what we aspire.
And you believe that that will happen in the next couple of quarters?
It should happen within next 2 quarters, I suppose.
Take that point. Thank you so much, Mr. Gandhi, for joining in and giving us an outlook, as always, once again. And the street will hold you on to these numbers, as always. Take a short break, come back, more on the markets on the other side.